welcome. You're watching Power Breakfast here on CNBC-TV18. I'm Sonal Bhutra and this is news coming in from Mumbai News Center. Well, a lot that we need to track, but first up, as always, let's take a look at what's happening in the Asian markets. Well, the Hong Kong markets are shut again for a holiday, so we don't have any cues coming in from there. But the Taiwanese markets up and about 0.7% gains is what we are seeing in the Taiwanese markets, and across the Asian markets, it's green across the Asian screen today because China has eased some restrictions, no quarantine rules for travelers coming from abroad from 8th of Jan, and this is something which has propelled the markets higher, and that is something we can see across the Asian markets as well. Kospi is up 0.6%. We have Nikkei sitting with gains of 0.5%. Shanghai too is high by 0.5%, and as a result of all of this, SGX Nifty is indicating that yes, the start could be in the green, but it is not as massive as the other indices are indicating. Remember, it was a massive rally that we saw yesterday as well, much higher than what SGX Nifty was indicating. Let's see which way things go today. And yes, lack of global cues in terms of the US markets as well. So yes, Asian market cues is something that we'll be watching out for. That's the global market action. How will these overnight cues impact our own markets? We have our research team joining in with what the trade setup looks like, the stocks that are likely to be in the news, and the action from the F&O space as well. Hey guys, a very good morning to all of you. Vivek, let me come across to you first. Not many cues from the global markets. US was shut. Even Europe did not have any cues coming in. So what are the market cues we need to watch out for today?
Well, good morning. Absolutely right. Most of US as well as European markets are on, celebrating their Christmas holidays and the Christmas break. So what actually happened was that US markets were shut yesterday. Some positive cues, if you could read into it, given the fact that the US Dow futures are indicating a mild gap up, in early start today. Now, also talking about European markets were closed. Most of these markets will be closed today as well. So I expect them to start trading from Wednesday. Now, talking about crude oil prices, now this is something that we need to keep an eye out for. The rally that we saw in crude oil prices has continued. Yesterday, we had indicated that, Russia indicating a cap as far as their output was concerned has caused a rally in crude oil prices. This has continued. So Brent futures now trading over $84 a barrel, and WTI futures too has now started trading over $80 a barrel. Now, coming to the Indian markets, yesterday was one day where we saw a very sharp rebound from last week's intense selling pressure that we witnessed. And in fact, the rebound was actually led by the sectors that actually saw the biggest cuts in last week's session. So the PSU banking index, the banking index saw, led the recovery. Mid-cap as well as the smaller cap actually outperformed the benchmark indices after quite a bit of time. So it'll be interesting to see whether this particular trend continues. The Nifty closed above the 18,000 level. So again, that'll be an important level to watch out for. Like you mentioned, China opening up, China relaxing the quarantine measures as far as inbound travel is concerned, has kept Asian markets in the green. SGX Nifty 2 is indicating a mildly positive start to our own markets.
Okay, all right. So those are all the cues for the trade today. Thanks a lot, Vivek, for that. Now over to Surbhi. She'll list out all the stocks that will be in focus today. Surbhi?
Hi, good morning. Thanks for that. So I have a few stocks on my watch list today. The first one is HEG, where the company has incorporated a wholly owned subsidiary, TACC, which will manufacture graphite anode for lithium-ion cells. Next is Time Technoplast, where the company has received an order worth 75 crores from Adani Total Gas for supply of CNG cascades. The delivery of cascades will begin from January of 2023. Next is NTPC, where the company signs an MOU with Technimont to explore green methanol production. And lastly, IRB Inwit. The toll connection on IRB Amritsar Toll Road has been temporarily suspended. This is because of farmers' agitation in the state of Punjab.
Okay, all right, Surbhi, thank you so much for joining us with all those details. And finally, Manglam is joining in with all the cues from the F&O space this morning. Hey, Manglam.
Good morning. So, yesterday we did see a strong bounce from the lows, and there was no two ways about it. The mid-cap index reclaimed almost 70% of Friday's loss as well. Let's take a look at the cash market flows then. The FII sold about 500 crores in the cash market. The DIIs bought about 1,300 odd crores, but that's really nothing to write home about, primarily because FII gross volumes were just about 30% of the daily average. So what fueled the rally? It was short covering that fueled the rally yesterday. Why is that? Because, we did see a fair amount of shorts covering their positions. The question is where we go from there, because yesterday towards the end that short covering did fizzle out a tad. The Nifty corrected about 70 points from the highs. The Nifty Bank also about 215 points. So let's talk about the short covering itself. The FII has covered around 12,000 short contracts in index futures, and as a result of which their longs moved slightly higher from 44% to 47%. But remember, they're still net short on index futures. We saw a lot of call writing in the previous trading session, and those call writers had to unwind their positions after a big up move that we saw yesterday. So 61,000 call contracts, short call contracts were covered, and on the other hand, we saw writing of 1.3 lakh put contracts, and that is something that will give bulls some confidence. We were talking about this during the day that we did see a fair amount of short covering in the 18,000 call and the 18,100 call, whereas at the same time we did see a fair amount of writing at the 18,000 put and the 17,800 and 17,900 puts as well. So that's telling you that there is strong support that the market sees between 17,850 to around 17,900 itself. And technically that ties in too, because the Nifty 100-day moving average was captured yesterday, reclaimed 17,848 is where it stands at. But on the way up, yesterday's high, which was closer to that 18,100 and 18,200, which is the 50-day moving average, may be a bit of a resistance, and that may come in play because of oil, which is closer to that $84.50 per barrel. For the Nifty Bank, 42,230 is what the 50-day moving average is. We conquered that yesterday, and 43,200 is the 20-day moving average. Let's see whether we go above that or not, or whether that faces resistance as well.
Yes, important levels to watch out for. Mangalam, Surbhi and Vivek, thank you so much for joining us and prepping us up for this trading day ahead. Let's do one thing, slip into a short break. Up next, more news and updates will follow on the other side. Welcome back. You're watching Power Breakfast here on CNBC-TV18, and as a part of our special series, Wizards of the Street, BSE member Ramesh Damani caught up with Prashant Khemka, who's the founder of White Oak Capital Management, and asked him about how India could become a major player in the global supply chain. They also discussed the prospects in the Indian IT sector. Let's listen in to what he had to say.
Globalization is very much there for good, and it is maybe a bit of a speed breaker in the interim, but for India it's actually can be a very positive game changer of sorts, because the companies worldwide are very keen to diversify their supply chains.
From China,
from
so it's the India plus one.
Absolutely. From excessive dependence on China, they want to diversify. India has the opportunity, and it should grab it with both hands, which it is doing so, but I think there's always room to do a lot more. It's an opportunity.
So Apple does 5,000 crores of iPhone sales. That telling sign to you?
That is certainly, from India's perspective, a very big positive. The opportunity size in front of us is, compared to that, is like tens of times, if not hundreds of times bigger, if you look at the manufacturing sector as a whole. IT services, if I take as an example, from time to time, they get written off by the market. One of the things that market has for the last decade or so believed is that IT services sector is an X-growth sector in India, because they think of, or X-growth sector because NESCOM and IT companies, they guide in dollar terms or constant currency terms, which are like dollar equivalent. So they talk about 7 to 8% growth. Now, in India, 7 to 8% growth doesn't appeal to anyone.
Doesn't wake up anyone.
Yeah, if you are less than double digit, you are no growth or slow growth company.
All right, that's an excerpt from a very interesting conversation with Prashant Khemka. With that, we'll move on. Tata Sons chairman N. Chandrasekaran delivered his New Year message to employees of the conglomerate, says increasing consumption, consumer confidence and investment will support India's growth story. Although the global environment has several risk factors, he said that the group experienced significant milestones in 2022, including welcoming Air India back, added that the group will approach 2023 with the theme of sustainability. Let's continue with the 2022 theme then. This year has seen pharma companies, barring a few such as Sun Pharma and Cipla, underperform the frontline indices. While the Pharma Nifty index has fallen 9%, the Nifty has risen a little less than that number. So what have been the highs and lows this year, and what lies ahead? Ekta Batra joins in to decipher the year gone by and what we can expect in 2023.
2022 saw opportunities from COVID-19 dwindling. Case in points with the likes of Serum stopping manufacturing of its AstraZeneca vaccine, Zydus and Dr. Reddy's COVID-19 vaccine sales not taking off, Wockhart's UK sales falling as supplies to the UK government dipped. And lastly, Divi's Labs seeing dwindling intermediate supply opportunities for Merck's COVID-19 drug Molnupiravir. For the US, an important development was a clutch of Indian companies such as Natco, Dr. Reddy's, Cipla launching the generic version of the blockbuster cancer drug Revlimid generic. Challenges included fierce price pressure in the US, continuing with the likes of Lupin exiting certain drugs and Aurobindo delaying its injectable sales guidance of $650 to $700 million to FY25. It was also a patchy year for US FTA inspections, with problems continuing for the likes of Sun's Halol facility, Cipla's Goa plant, Glenmark's Baddi plant. Price pressure, delayed launches in the US, supply challenges along with inflation weighed on most companies' margins in FY23. Gland and Divi saw margins sharply fall year-on-year in first half. Aurobindo reported margins at multi-quarter lows of 13.7% in Q2. And while Lupin saw a recovery in margins in Q2, it disappointed with margins hitting lows of 7% at one point. 2022 was a year of acquisitions in India as companies scouted for growth. We saw companies either buying one or a portfolio of brands such as Dr. Reddy's and JP Chemicals, buying cardio drugs from Novartis, or Mankind scooping up Panacea's domestic brands. Not in the domestic market, but this year was also marked with the $3 billion buyout of the global company Viatris's biosimilar business by Biocon. So what is the way forward in 2023? The ability to withstand price pressure in the US, which would be fueled by key drug launches in the US such as Lupin's inhaler drug Spiriva generic, Cipla's cancer drug Abrixon, or Biocon's biosimilar insulin aspart and bevacizumab, and continued sales for Sun Pharma's specialty business. 2023 will also be marked by companies undertaking remediation to solve their outstanding US FTA issues and taking steps to fuel growth in other markets such as India and even China. As always, let's leave you with the valuations of companies on an FY24 basis, what they started 2022 with and where they are ending the year with.
Ekta, thank you so much for that comprehensive coverage on what happened in the pharma space and what's the outlook going forward as well. On to a CNBC-TV18 exclusive now. As the relaunch of Jet Airways continues to remain uncertain, we learn from sources that the Jalan Kalrock consortium is having to say goodbye to some senior and mid-senior level employees along with pilots and cabin crew. Madiha Mujawar joins us with more details on this. Madiha, what's happening at Jet Airways?
Well, many factors at play here that explain why Jet Airways is seeing departure of employees even before the much talked about relaunch. Let me first begin with what sources have told CNBC-TV18. Among the top exits, the Vice President of Engineering and the Vice President of Human Resources have exited Jet Airways. Besides other senior management, the Chief Executive Officer and Chief Financial Officer are working on slashed salaries. The Vice President of In-Flight Services has been sent on leave without pay. The company had kept pilots and cabin crew on standby for the relaunch, but we learned that many of these pilots and cabin crew have quit to join other airlines. Now, these were employees from the core team. Now, ever since the Jalan Kalrock consortium implemented the cost-cutting measures, some staff at the managerial and junior level who were either given pay cuts or sent on leave without pay have also quit the company. Sources tell us some mid-senior level employees currently working with Jet at a reduced salary or no pay at all are in the process of joining other airlines. Let me tell you, these developments are not surprising given the standoff between the Jalan Kalrock consortium and the lenders over the transfer of airlines ownership. Matters even got more complicated after the NCLAT order that directed the consortium to make additional payments for PF and gratuity of employees. So with payments not made, ownership not transferred, and employees losing patience, the future of Jet Airways 2.0 remains quite uncertain.
Okay, Madiha, thank you so much for joining us with those important details. We'll keep coming back to you for more updates on the same. With that, we'll slip into a break now. Up next, we'll get you all the cues from the commodities market. Stay tuned. Welcome back. Still tuned into Power Breakfast here on CNBC-TV18. Let's talk commodities now. A reaction that we are seeing in the crude prices on the back of some updates coming in from China. Manisha Gupta is here to analyze that for us. Manisha?
Yeah, well, thank you so much for that. We have seen the crude oil prices continue to trade in the positive. We are looking at 83, 84 kind of levels continue to hold, even as the volumes are quite thin, but we seem to have gained overnight in 24 hours as well. The U.S. markets were shut, but there is a bit of a buying that we did see come in from the Asian markets there. But even better gains is what we saw in the U.S. gas prices, 3.5% of gains. And the markets are looking at a freezing winter there. The kind of storm Elliott has brought in has led to freezing of gas and oil pipelines as well. But another developing statement coming in from Russia has been that they are ready to resume the Yamal-Europe pipeline, and nearly 21 billion cubic meter of LNG to Europe was shipped in 2022. I mean, what does it mean is something that the markets will really have to see. We have seen the Europe gas prices continue to decline because there is availability, and with these kind of statements from Russia, really would ease off further tension there. I want to make a quick remark about steel prices also, where we are looking at buying coming back in case of China. We are trading at near 4-month highs. There are hopes of additional policy support in China. The government has indicated that they will mandate policies to spur economic activity in the first quarter of 2023, and that's exactly what the markets are waiting for.
Okay, all right, Manisha, thank you so much for that wrap. So bullish cues coming in from the commodity markets. What's the reason? It's definitely what's happening in China as well. So let's get you the latest on the COVID situation in China. Starting early next year, Beijing will drop quarantine for travelers arriving from abroad. CNBC Asia files this report.
Beijing has taken another major step, in fact, the final step, really, to dismantle its harsh COVID restrictions. The country's National Health Commission has announced it'll scrap the quarantine requirements for inbound travellers from January the 8th of next year, which is literally less than 2 weeks away. This will end the current regime, which involves 5 days of mandatory hotel quarantine and 3 days of self-isolation at home. But travellers to China will still be required to obtain negative COVID test results within 48 hours of their departure. China will also downgrade COVID-19 from a Class A infectious disease rating to Class B, meaning that local authorities can no longer shut down entire communities with COVID as a reason. That'll start next month as well.
So let's focus on the situation in India. Health Minister Mansukh Mandavia held a meeting with prominent doctors and members of the Indian Medical Association regarding the COVID situation in the country. The health minister in the meeting emphasized on the need to ignore fake news regarding the disease and avoid unnecessary panic. He also stressed on the need to observe masking and hand hygiene. The health minister also asked doctors participating in TV debates to dispel rumors about the disease. He also clarified that the BF7 variant was already present in India. There was no need to be worried, as a no-zero COVID policy along with high vaccination have built natural immunity in the population. The government has also asked hospitals across the country to conduct drills to test COVID preparedness later today. Okay, with that, let's move on. Cold wave grips large parts of northern India, with the mercury dipping sharply in Delhi, Punjab, Uttar Pradesh, Haryana and Rajasthan. The IMD has predicted severe cold wave conditions across parts of northern India over the next 3 days, as minimum temperatures dropped below the normal yesterday at some locations. It also forecast dense to very dense fog over parts of Punjab, Haryana, Delhi, Uttarakhand and western Rajasthan over the next 2 days. The weather agency sees the intensity of the cold wave decrease over northwest India from tomorrow morning and then abate. Okay, that is something that we can feel in Bombay also. Chilly mornings, but of course not as severe as we are seeing in the north. And with that, we'll take your leave on this edition of Power Breakfast. Stay tuned. Bazaar Morning Call will take all the action ahead.